Hello, Joe Follico here for Insignia Futures and Options. In this video, I'll be explaining margin requirements in commodity futures trading, so don't go away. A very common misunderstanding for investors new to futures trading is the term margin requirement, and what exactly that means. Margin when trading futures does not refer to a loan of funds, such as it does when trading stocks. When trading commodity futures, the term margin requirement is the amount of funds an investor must have available in their trading account to trade a particular futures contract. Think of margin as a performance bond. These funds act as a deposit of good faith in return for establishing a position in a given futures contract. For example, if an investor wished to establish a position in crude oil futures, they currently would need to have a minimum of $6,380 in available funds in their account to take a long or short position for one crude oil futures contract. Again, this margin amount is not deducted from the client's futures trading account. It is now simply acting as a bond, enabling the futures trader to hold a position in the crude oil futures market. I do need to remind everyone that based upon market conditions, margin requirements can be increased or modified. Each futures contract will have its own set of three margin requirement amounts: initial, maintenance, and day trade. Let's review each of these three. Initial margin can also be thought of as day one margin, the amount of funds required when a futures position is originally established. This amount is typically between 5 and 10% of the futures contract's overall value. Initial margin is used for trades to be held longer than one trading session. Using soybean futures as an example, the current initial margin requirement is $2,915 per contract. If a trader establishes a position in this market, they will need to minimally have this amount of available funds in their trading account when the soybeans market closes for that day to be in margin compliance. Next, we have maintenance margin. Maintenance margin is a lower margin requirement that comes into play starting with the second day of an established futures position. Essentially, the futures exchange lowers the margin requirement down to maintenance margin to give the futures positions room to fluctuate. Using soybean futures as our example again, the current maintenance margin requirement is $2,650, $265 less than the initial margin requirement. Finally, we have day trade margin. This is the lowest amount of funds required to trade a futures contract and only applies to positions held for the current trading session. Day trade margins vary from broker to broker, but are typically 50 to 75% lower than the initial margin requirement. At Insignia Futures and Options, our standard day trade margins are set at 75% lower than the initial margin. For example, the current day trade margin for the Micro E-mini S&P 500 futures contract is only $316. With Insignia Futures and Options, all trades are considered to be day trades until the current trading session ends. I hope you're finding this video informative. Please take a moment to click the like and subscribe buttons below if you'd like to see more videos like these. Now let's talk about margin calls. If your account equity falls below the current margin requirement, you'll receive a margin call. A margin call is a request from your futures broker to either deposit funds into your futures trading account or liquidate the necessary futures positions to bring your account value back into margin compliance. Most futures brokers require margin calls to be taken care of immediately. If a margin call is not satisfied, the futures broker has the right to liquidate any open positions in order to satisfy the margin deficit. Let's look at an example using a Canadian dollar futures contract. The current initial margin requirement to trade one Canadian dollar futures contract is $1,628, and the day trade margin is $407. To establish a position, a trader would need to minimally have $407 in their account to go long or short one contract. Once the position is established, the trader's account balance must stay above the day trade margin of $407 for that day's trading session. A margin call will be generated if the account balance were to drop below the day trade margin amount. If the trader decides to hold the position past the market close, the trade is no longer considered a day trade. The trader would then need to have the full initial margin requirement of $1,628 in their account to continue to hold the position. A margin call will be generated if the trader's account balance is below the initial margin requirement. Assuming that the trader's account balance was above the initial margin requirement, then starting with the next day, the margin requirement would be lowered to the maintenance level, $1,480 in this case. The maintenance margin will remain in effect for the life of the trade from this point forward. One of the biggest misconceptions with initial and maintenance margin requirements is when it comes to margin calls. Many traders believe that if they receive a margin call, they only need to deposit enough funds to bring their futures trading account balance back up to the maintenance level. This is not true. Once a margin call has been generated, the futures exchange requires the equity in a futures trading account to be brought back up to the full initial margin requirement. Then the whole process of initial margin and maintenance margin starts all over again. I know some of this may seem confusing, but Insignia Futures and Options clients will have complete margin requirement information posted in their online trading platforms, which is always current. As always, if you have any questions, please leave them in the comments below or feel free to contact me directly. I'll be happy to help.